Hello everyone, my name is Frichilar Tipandan, and today I will be continuing our report about Chapter 2, and we will start with Section 33 that talks about accounting standards for revenue. So, under this section, it explains what kinds of money or resources are considered as revenue by the government. So, these accounting rules are based on the PPSAS. Now let's first tackle about revenue. So revenue is all the money or benefits the government earns or is expected to receive for its own use. So this includes things like taxes or service fees. So it does not include money the government just passes along to someone else. Like for example, if a government agency charges for ID cards, the payment will be considered as the revenue. Now next is the receipts or collections. So it is cash actually received from all sources within a given accounting period. So it refers to actual cash received by the government. Not just what is expected, but what has really been collected within a specific time period. Think of it as money already in hand. Like when a student pays for the school ID and the office receives the payment on the same day. Now next is fines. So fines are penalties collected when someone breaks a rule or law, like speeding or not paying taxes on time. These are counted as income only when they are actually paid, not when they are just decided by a court. Fines help the government enforce discipline and laws. Now next is gifts or donations. These are voluntary transfers of assets or services, usually without stipulations. So these are money, goods, or services given freely without expecting anything in return. Like for example, when a private company donates computers to public schools, it will be considered as a donation. Now next is goods in kind. So instead of giving money, some donors give actual items such as foods, medicine, or books. And these are called goods in kind. These are still counted as revenue because they have value and benefit the government. So next is the taxes. So these are mandatory payments made by individuals or businesses to the government. So this provide funding for public services like education, health, and infrastructures. So taxes are not fines. Remember that taxes are not fines. They are collected as part of a citizen's duty under the law. So they are very mandatory. Now last is transfers. So transfers are non-exchange payments given to the government other than taxes. For example, if one government agency sends funds to another for a special project, that's called a transfer. No goods or services are given in return. It's just mere support for them. Now, next to discuss will be Section 34. So, Section 34 talks about the use of appropriated funds. Money that is appropriated or formally assigned in the budget for specific projects must be used only for those specific purposes. So if the Congress approves a 10 million pesos for building schools, that money can't be spent on vehicles or uniforms. It should be spent on the project itself, which is to build schools. Next is Section 35, which is the appropriation for loan proceeds. So this explains that any government spending funded by loans, whether borrowed from foreign or local sources, must first be properly included in the agency's official expenditure program. So this means that even if the loan money can be is already available, whether in cash or in kind, like goods or equipment, it cannot be used right away. Before spending, the agency must secure a special budget, which is a formal authorization that specifies how the loan proceeds will be used. So this ensures that borrowed funds are managed with the same level of control and accountability as regular government funds. The rule is important because it promotes transparency, avoids unauthorized use of borrowed money, and ensures that loans are spent on their intended purpose for the benefit of the public. Now next is the Section 36, which talks about the basic requirements for disbursements and certifications. So before the government can spend any money, it needs to follow strict rules to make sure that public funds are being used properly within the budget. These following steps help prevent corruption, overspending, or illegal transactions. So, first is the availability of allotment or budget certified by the budget officer. So this means that the budget officer must first confirm if there's budget set aside for the planned expense. Like, for example, before buying supplies for a public school, the budget officer must check if there's money in the budget specifically for that purpose. Next is proper obligation against the available budget by the chief accountant. So the chief accountant must make sure that the amount being spent is recorded correctly under the right budget category or project. Next is the availability of funds, which is certified by the chief accountant also. So they will be the one that check if the actual funds are available in the government's account before any contract is signed or any payment is promised. So this protects the government from agreeing to expenses they can't afford. It's like making sure there's money in your wallet before you buy something. Next is the availability of cash certified by the chief accountant also. So aside from funds being available on paper, the real cash must also be ready for release. So the chief accountant must double check that the documents are complete and that the actual cash is available. Next is the legality and conformity. So the person requesting and approving the disbursement must make sure the spending is legal and follows all government rules. Like, for example, if someone tries to spend money on something not allowed in the budget, like buying personal items, this should be rejected. Next is the validity of claim, which or also known as proper documentation and proof of the claim. So all government payments must be backed by real documents or supporting documents like receipts, invoices, contracts, or delivery reports. This must be reviewed and signed by the head of the requesting unit, who confirms that the expense is necessary, complete, and valid, and the claim is legal and appropriate. Now last is the approval by the head or agency head or authorized representative. So finally, before the government can actually release or disburse money, the transaction must be signed and approved by the head of the agency or someone they officially authorize. Like, no payment should be made without the final approval. It's like asking for your principal's final signature so that your proposal for the events you have planned will be totally approved. Now next is section 33, which talks about the certification of availability of funds. So this rule says no spending or obligation should be made unless the chief accountant first certifies that there are funds available for it. Also, if every payment must be backed by valid documents. So if someone issues a false certification, such as for a fake payment or non-existent supplier, that certification is considered void. and the person who signed it can be removed from service and may also face criminal charges under the law. Additionally, anyone involved in making, authorizing, or benefiting from that illegal payment will be held jointly and severally liable, meaning all of them can be made to return to the full amount to the government. This section protects public funds by making sure that only legitimate, properly documented, and authorized transactions are allowed. Now next is Section 38, Prohibition Against Overdraft. So this states that government agencies, departments, bureaus, or offices are strictly not allowed to spend more than the budget given to them by the Department of Budget and Management, or also known as the DBM. This means that all expenses must stay within the authorized budget limit, and no one is allowed to approve or commit funds that go beyond what has been officially released. If someone allows or causes an overdraft, which is spending more than what's available, they will be held personally responsible. This could mean facing administrative, civil, or even criminal consequences. The purpose of this rule is to enforce fiscal discipline, avoid debt or deficits, and make sure public funds are used wisely and within the limits. Now next is the Section 39, which is the mode of disbursement. So this explains the different ways that national government or agencies or NGAs can release or pay out government funds. Disbursements may be done through the Treasury Single Account or TSA, which is a centralized system that helps manage all government money efficiently. And payments can also be made using a modified disbursement system or MDS check, which is a special check issued by the government for its expenses, and or a commercial check also, which functions like a regular bank check. For certain needs, agencies may release funds in cash through a cash advance, usually for small or urgent expenses. And another method is the Advice to Debit Account or ADA, which is an electronic transfer of funds from the government's account to the payer's account. Now next is the Section 40, which is about authority to disburse. Now this section explains that national government agencies can also only release or spend government money if they have proper legal authority. This authority comes in the form of official documents such as the Notice of Cash Allocation or NCA, Notice of Transfer of Allocation or NTA, or Cash Disbursement Ceiling or CDC. And these are like go signals from the DBM that tell the agency how much money they're allowed to spend and when. Without these documents, any payment or disbursement is considered unauthorized. Next is Section 41, which talks about disbursement voucher or payroll. So before any payment is made, whether by check or electronic fund transfer, there must be a disbursement voucher or payroll that has been properly filed out, approved, and signed. The DV or payroll serves as the official proof that the payment is valid, necessary, and authorized. It also includes supporting documents like receipts, contracts, or billing statements. So no money should be released unless there is a DV or payroll to back it up. Next is Section 42, which talks about the maintenance of records. So every check of aid or ADA issued during the day, whether it was released, unreleased, or even cancelled, must be recorded in order in a document called the Checks or ADA Disbursement Record. This record is kept by the cash or treasury unit of the agency. And the goal is to ensure complete and traceable records of all money movements, or so that there is accountability for every peso disbursed. Now last is section 43, which is about reporting of disbursements. So all payments made by the agency must be reported using official standardized forms. These reports are then recorded in the agency's books of accounts, which are part of the government's financial records. This step ensures transparency, accurate accounting, and proper auditing of public funds, so no money disappears or gets misused. So to wrap it all up, we hope this presentation help you understand the general provisions, basic standards, and policies of government accounting. As Abraham Lincoln once said, "Government of the people, by the people, for the people, shall not perish from the earth." Let us remember that every peso collected and spent must reflect that purpose, to serve the people. Thank you for your time and attention.